Hey gang, Adam Von Romer here, author, speaker, seminar leader, founder of the Commercial Investment Real Estate Academy, and 32-year veteran of commercial real estate. And today's message is I want to show you how you can save $10, $20, or even $100,000 or more on your home mortgage and how you can do that for free. And like I say here on the screen, P.S. your lender hates this secret, but you'll absolutely love it. So let's get started with a little bit of Real Estate 101, shall we? First off, how to beat your lender at their own game. Understand this, mortgages are, in America, paid in arrears. In other words, when you make May's payment, you're actually paying for money you used in April. So when you make June's payment, you're actually paying for May, etc., etc., etc. So your mortgages are going to always be paid in arrears. Residential mortgages are usually almost always fully amortized. And what that means is that it's self-liquidating. With each and every payment you make, you owe less and less money to the lender. And at some point in time in the future, you're actually going to own the home outright. So they're self-amortizing, and all amortizing means is to kill the payments off or to kill off the debt. Interest is paid only on the money you use. So as long as that money is outstanding, the lender is entitled to collect interest on it, and interest to a lender is profit. That's how they make a living. And if you don't use their money, you don't have to pay interest on it. And I'm going to show you what that means a little bit later on here, but just kind of follow me here. So here's what a typical loan amortization table looks like. And don't get hung up on the numbers, just follow along here. If you look in the upper left, it talks about a loan amount. So we're going to borrow, in this case, $125,000. The interest rate on the loan is going to be 10%. It's going to be a 30-year mortgage with 12 payments per year, and it's going to start in August of 2015. Now, if you hop over to the other side, it shows you on the upper right-hand side, the loan payment is $1,096.96 a month. We're going to make 360 payments. And if you did that in accordance with your loan documents, you will pay back $269,907 to the lender. Now remember, you only borrowed $125,000. So you're going to pay nearly 3 times as much back to the lender as you borrowed originally. Well, I'm going to show you how to kind of beat them at their own game here. So let's take a look at something else here. If you look, here's your monthly payment. And those monthly payments go out for 360 installments or 360 payments. So if you look carefully, you'll see that every month there's a payment due of $1,096.96. Now, if you skip over a column or two, you'll see that there's the interest, and that's the interest portion of that monthly payment. In this case, the first monthly payment has interest of $1,041.67. That's prepaid profit to the lender. Has absolutely nothing to do with you, your loan, or your home. That's the lender's profit. And then here's what you're actually paying into your home. In other words, $55.30 of that $1,096.96 is literally going to pay down your debt. Is it any wonder that lenders like to do this? I mean, they're making 20 times as much each and every payment as you're paying into your house. And that's how they make $269,907 on the life of the loan. Any wonder why they make those loans? Look at that. Now, admittedly, they get it over time, but that's still an awful lot of money. And I'm going to show you how to save that and kind of keep that in your own pocket. The other thing is you should always, always, always try to pay your own personal residence off as quickly as possible, because that's a real asset for you. So let's take a look at this. Here's how you beat them. Number one, you saw that column marked principal, and in that column it was $55.30. The next payment goes up a whopping 46 cents to $55.76. So here's what you do. Next time you make a payment to the lender, in this case, send an additional $55.76, okay? Now, by prepaying the principal amount, you're not technically borrowing the money. So you don't have to pay that interest payment. Now, if you don't borrow it, you don't pay it. So here we go. Here's our principal, $55.76. And all I'm suggesting you do is make one additional payment. And you can see what the next ones would be if you go right down the column. But $55.76 eliminates $1,041.21 in interest. So literally, by you prepaying that $55.76, you're saving over $1,000 in interest. Now, again, it doesn't mean you don't have to make next month's payment, but what it does do is it's killing off that loan much quicker by making that additional principal payment. So if you could put an extra payment of $1,096.96 on that particular property, here's what would happen. You'd eliminate approximately 20 interest payments. Now remember, each and every one of those interest payments is $1,041. So you'd save in excess of $20,000 simply by making one extra payment of $1,096.96. And what it does is it doesn't relieve you of next month's payment, but what it does do is it pulls the maturity date of the loan forward in time. So now you no longer have a 30-year loan, you're down to a 28-year loan. So that maturity date's moving forward. You're not relieved of next month's payment, but you are shortening the loan. Now, here's a couple of words of caution. Number one, always send that additional payment separately. Always, always, always. Don't put it on the check that you send to the lender, because they'll apply that overage, if you will, directly to principal. In other words, they'll pay themselves first. Always mark your check principal only. Put that in the memo. That way that they will pay attention and hopefully credit it to the right portion of your payment. And keep an amortization schedule. That way you can track the amounts that you paid and when you paid them. Because I know it's shocking and hard to believe, but sometimes lenders don't play nice or they lose things. And there are certain lenders who, if you don't do it specifically and expressly, are going to prepay themselves. Some government-insured or guaranteed loans limit the amount that you can pay down each and every year to 25% or less of the loan balance. Well, unless you're going to pay off $25,000 or $30,000 a year, you shouldn't have any problem with the lender. You cannot skip the next payment. In fact, the next payment's still due next month, but if you make that little bit of extra payment, it pulls your maturity date forward in time. And then a final word or two. Number one, if you could pay an extra $1,096.96 each month, you would effectively reduce that loan from 30 years to just 8 years. You'd reduce the total overall interest from $269,907 to just $45,000. That's a huge savings. And the fact of the matter is, you'd literally cut your interest rate to somewhere just below 2%. So from 10% to just under 2%, and you saved yourself $200,000 and then some. Doesn't sound like a bad plan to me. Beat the bank at their own game. Start sending in an extra principal payment this month and watch what happens. Thanks for taking the time to watch my video. I hope you got it. If you have any questions or comments, just simply email me, avonromer@outlook.com. Thanks for watching, and I'll talk to you again soon.